Hello, I'm Peter Switzer. Welcome to the program which puts you in touch with the best and brightest minds in the business. On the show tonight, CommSec's Tom Piotrowski will tell us if these 2 down days on the market are the start of something bad. Melbourne Uni's legendary Professor of Economics, Neville Norman, will tell us what his venerable crystal ball says about the economy and the stock market. You don't want to miss this one. Former New South Wales Opposition Leader Peter Collins will look at what a country full of Conservative governments will mean for a business that he owns that generally will be better off because of it. He's also been made chairman of Industry Super Network, and we'll talk to him about that. David Green of AFEX will tell us what he thinks lies ahead for the Oz dollar, and we will meet Shane Hills, who started a chocolate business with the help of a city council and now employs 250 people. A council that helps business. We'd all like to hear about that, so stand by. Stay with us for the next hour. We'll bring you all the latest corporate news and market analysis, plus learn some valuable lessons from Australian success stories. If you have any questions for me or our guests, email them to switzer@skynews.com.au. You can follow me on Twitter, and the handle is @PeterSwitzer. But first, let's look at the day's top business stories with Ingrid Wellinge.
Thanks very much, Peter.
Pleasure.
Well, the local share market closed lower today. The S&P ASX 200 down about 0.6% at 5,352 points at the close. The performance of the different sectors in the healthcare space, the only one in the black today, up about 0.8%. The different story, though, for the industrial sector, it was down about 1.1% today, the worst performer. We saw 32 stocks rise today, while pretty much the rest of the market, 154 stocks fell, 14 held steady. Taking a look at the biggest movers in terms of index weight, and CSL led the market higher. It was up about 1.5 index points. Sonic Healthcare also stronger, a rise of about 0.7 of an index point. Commonwealth Property, Bank of Queensland and APA Group also making that list today. On the flip side, the biggest drag on the market by index weight, Westpac fell over 4 index points. NAB also weaker, down about 2.7 index points. Westfield, Telstra and ANZ rounding out the bottom movers by index weight. Well, the RBA says there's mounting evidence past interest rate cuts are stimulating the economy, while not ruling out further easing if necessary. In the minutes of the policy meeting, the central bank again cautioned that the local currency remained painfully high and further declines would be needed to spark a broader economic recovery. The tone of the minutes was similar to the central bank's quarterly policy report, in which it left the door open for further rate cuts. On the recent improvement in business confidence, the RBA said it was too early to tell if this meant that businesses would take on new risks and add to employment and investment. And Seven Group says it's well placed to take advantage of the improving economic outlook. Speaking at the AGM in Sydney, Chairman Kerry Stokes says the company is focusing on structuring its WesTrac business to meet those changing demands of the mining, resource and infrastructure sectors. Despite the challenging conditions, though, for WesTrac's operations in China, Mr Stokes remains optimistic about the outlook. And that is all from me for the moment. Back to you, Peter.
Thanks, Ingrid. OK, the market was down again, so is this the start of an overdue correction? Let's ask the redoubtable Tom Piotrowski of CommSec what he thinks. How are you, Tom?
G'day, Peter.
What do you think, Tom? Is this the start of that overdue correction?
Well, I think for some time now we've heard a group of voices in the market calling for the need for a correction, and every time we have seen the market pull back over the course of recent months, the dips have tended to be quite shallow, and we've seen the volume move back into the market to support that weakness. So I think you probably need a significant catalyst to change the thinking of the markets if you're going to see an inflection point or a turning point. I don't know if that's been in the offing as far as the last couple of or the next couple of weeks are concerned, or whether or not we've seen anything in weeks gone by that might reasonably fall in that category. I think, in the bigger picture, Peter, we still need to get that tapering timetable down with a little more precision, because that's really the next significant obstacle, and that'll be the biggest hurdle for the markets to get around, even though we've been discussing this for the last 6 months, is how are they going to respond to that winding back of cheap money, which has been such a big free kick for the markets.
It seems to me, Tom, people like me like to think that history can be our guide. It's actually been good for me so far over the last 5 years, and me being pretty well right on just about everything. But history can go against us at times. But on a history basis, you'd think, okay, we get the Santa Claus rally. History usually tells us this. We overcome the debt deficit argument will start in December and roll over January, February. Then maybe in March they'll start tapering. Then they'll sell off because interest rates will start to rise. And then people will say, oh, gee, but the US economy is doing well. That's why they're tapering. Then the market takes off again. In a perfect world, that's the script, isn't it, that we see followed on the market.
Look, I think that as much as you can be correct about the way that you might navigate the next couple of months, that's a reasonable course that you would think we might follow. But then again, it never goes to script.
No.
I think we heard from Ms. Yellen last week. The market seemed to be encouraged by the sort of conversation that she was having with legislators. It seems as though it's going to be a continuation from the Bernanke era. It seems as though, first and foremost, it's the growth prospects that the Fed wants to underwrite. That's helpful, but the question is whether or not we're going to see all of those pieces fall into place in the early part of the next year. Even navigating the debt ceiling once again. These are the sort of obstacles that just seem to step in front of the market every time we appear to be getting a little bit of momentum going as far as the growth equation is concerned. Yeah,
and of course the Reserve Bank Governor Glenn Stevens, he'd love tapering to start, wouldn't it? Because that would probably help the Aussie dollar come down. I think he's pretty happy with the response of interest rate sensitive sectors to his cuts in interest rates, but that dollar still is worrying him, isn't it?
You're absolutely right. There's not much that any central bank official outside of the Fed can do as far as influencing their currency against what's happening with the US dollar. That is the fundamental driver of not only currencies but so many other asset markets as well. The RBA generally tends not to talk down the currency, but it's really been the only option it's had over the course of recent history, because nothing else matters in the face of what the Fed's doing.
Without a doubt. Tom, thanks for joining us.
Thanks, Peter.
Carl Icahn is one of the world's biggest whales when it comes to investing, and he recently said he's very nervous about stocks, and this apparently hurt stocks on Wall Street overnight. These guys worry me because they can move markets, and who knows whether they use their power to their advantage. So the question is, should you listen to big mouth hotshots? For the record, on March 23, 2012, he said he was very nervous about CIT debt. And if you Google Carl Icahn and very nervous, there are lots of instances where Carl is nervous. And with his big bets, he should be. Have a look at how the UK's Mail Online summed up his market impact on Apple. Carl Icahn told his 40,000 followers, "We have a large position in Apple." His tweet came at 2:21 and it sent the share price skywards, the Mail said. And 1 p.m, Apple was valued at $472 billion, but by 4 p.m, it was $489 billion. In the age of Twitter, these guys carry enormous weight, and their tweets could become a big story starring a regulator one of these days. But let's assess what he's saying. He's very nervous about stocks, and so why? Well, locally, the likes of Jeff Wilson of WAM says he thinks the market has gone up so far since the middle of last year that a pullback is overdue. Fund manager Roger Montgomery says he can't find any value in the market, which could mean the wind could be taken out of the sails of the stock market. In the USA, the S&P 500 is up over 26% this year, but 2003 it was actually a bigger rise. The small cap Russell 2000 index is up a huge 31% this year, while the Dow is up 22%. Importantly, Barron's points out that the S&P 500 is valued at 16 times projected 2013 operating profits of $109 and 15 times estimated 2014 earnings of $120. The index is forward PE is calculated to be 15.6, which all looks pretty good for stocks going forward. Tom Lee, a JP Morgan analyst, argues we have 3 years left in this bull market rally, and so being nervous for someone as rich as Carl Icahn is really only a short-term nervous thing. I want to read Carl's tweet when he says, "I have liquidated all my stocks," and I want to read it ASAP after he tweets it, as it could cause a big rush for the exit doors on Wall Street, but not now. After the break, we'll talk to an academic who knows almost everything about everything, so stick around.